Hi, everyone. In our corporate tax series, we've been conducting a series of videos on the consultation document issued by the Ministry of Finance on corporate tax and transfer pricing. Today, we're going to cover calculation of taxable income. So the starting point for calculation of taxable income is going to be accounting net profit as stated in the financial statements for determining the taxable income. Financial statement should be prepared using acceptable accounting standards and principles that are acceptable in U.A.E. So generally, although international financial reporting standards are commonly used in U.A.E, consideration is being given for an alternative financial reporting standards and mechanism for determining the taxable income to accommodate a small and medium-sized businesses, so reduce certain complexities of compliance with IFRS. So the next step on this is there are certain adjustments on this taxable income. The treatment of unrealized gains and losses. So in the accrual basis, when you prepare a profit and loss account, there are certain unrealized gains and losses which can be formed out of the profit and loss account. As per the consultation document, so whatever unrealized gains and losses pertaining to capital items should be adjusted from the taxable income. So whatever gains and losses, unrealized gains and losses related to the revenue items doesn't require any adjustment. Exempt income. So there are certain income going to be exempted from the U.A.E corporate tax. Mainly the exemptions for dividends and capital gains. So U.A.E's CT regime will exempt all domestic dividends and capital gains earned from U.A.E companies, including dividends paid by a free zone person that benefits from zero CT regime. So all the dividends is going to be exempted. Dividends paid by foreign companies and capital gains from the sale of shares in both foreign in U.A.E companies will also be exempt from the corporate tax, provided certain conditions are met. So what are all the conditions to be met for exemption of capital gains from the U.A.E corporate tax? The U.A.E parent company must hold at least 5% shares of the subsidiary company, the foreign subsidiary company. The participation exemption only be available if the foreign subsidiary is subject to CT, which is not less than 9%. If your foreign subsidiary is a zero tax jurisdiction, it's still this income will be taxable. The capital gains will be taxable anyway for those subsidiaries. So further on the exempt income, U.A.E city regime will exempt income earned by a non-resident from operating or leasing aircraft or ships used in international transportation, provided the same treatment is granted to U.A.E businesses in the relevant foreign jurisdiction under the reciprocity principle. With this video, we will be covering the income and adjustments to the income. Next video, what we could look into is expenses, deduction limitations. So there are expenses, whatever has been booked in the profit and loss account, it requires an adjustment. So which we can cover in the next video. See you next time. Until then, thank you.